Good morning and welcome to the Killik and Co Market Update. The big question this week is the US economy in recession? Officially, the definition of a technical recession is 2 consecutive quarters of falling output. And yesterday, the US reported its latest GDP numbers, and they did show 2 consecutive quarters of falling output. However, many officials in the US are now saying they're not going to classify this as a recession because in many ways it doesn't feel like one. In a recession, you would expect to see weakness across all areas of the economy. You would expect to see firms pulling back on hiring and laying off staff, but at the moment, we're really not seeing that. We're seeing a very strong labour market. Here are some comments from the chairman of the Federal Reserve, Jerome Powell, that he made in a press conference this week. He said that growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. He said that activity in the housing sector has weakened, in part reflecting higher mortgage rates. But he also said that despite these developments, the labour market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. And then he also said that labour demand is very strong, while labour supply remains subdued, with the labour force participation rate unchanged since January. Overall, the continued strength of the labour market suggests that underlying aggregate demand remains solid. And we can see further evidence of this strong labour market by looking at what recruitment companies are saying at the moment. This week we had results from a recruitment company called Robert Walters, which is listed in the UK, but it operates all over the world and it does have some exposure to the US. And the company has just reported the best results it's ever had. And in particular, the CEO said that an acute shortage of professionals coupled with growing wage inflation has resulted in a significant increase in job churn and a fierce competition for talent. Looking ahead, we are yet to see signs of any slowdown in job market activity, despite the volatile macroeconomic backdrop and inflationary pressure that is being experienced across global markets. We're in the middle of reporting season at the moment, so it's been a very busy couple of weeks for results. Investors were quite concerned as we went into this reporting season because we've got costs going up, we've got high inflation. There was some concern that many companies would start to downgrade their profit outlooks for the current year. However, so far, this reporting season has not been as bad as many investors feared. In particular, there was quite a lot of concern about big tech. These companies have been growing incredibly quickly over the last decade, and in many ways they've really driven the stock market higher. But there was some concern about how they would fare in an environment with higher interest rates and slower growth. In particular, there was some concern about Amazon. Here's the share price chart over the last 5 years. And you can see that over the course of this year, the share price fell from over $180 to below $120, losing over 1/3 of its value. However, the company reported results last night and they came in quite far ahead of expectations. The company has confirmed its profit guidance for the full year, and it did publish particularly good results in its Amazon Web Services cloud computing division, showing a 33% rate of growth compared to last year. The shares were up over 10% in after-hours trading last night, which is not reflected in this particular chart here. We've also had reassuring results from other companies in big tech, including Apple, Alphabet, and Microsoft. All of these companies reported results that reassured investors, and all of these companies experienced rises in their share prices after publishing their results. Overall, so far, this has been quite a reassuring reporting season, and we have seen global markets moving higher over the last couple of weeks, as you can see by this price chart showing the performance of the MSCI World Index. And finally this week, it's worth mentioning McDonald's, which announced this week it will be raising the price of its single cheeseburger here in the UK for the first time in 14 years. The price will be going up from 99p to £1.19, which does show that McDonald's is certainly not immune from the inflationary pressures and the cost pressures that many other companies are experiencing at the moment. However, despite this, McDonald's results yesterday still exceeded expectations. And actually, McDonald's is a company that has historically performed well in times of recession or slower economic growth. The reason being that McDonald's sells relatively cheap items and therefore it tends to benefit from customers trading down. Having a look at the share price chart here, you can see that McDonald's shares are currently fairly close to their record high, and furthermore the shares have actually gone up over the last few months while the rest of the market has been falling. Moving on to have a look at next week, we're looking particularly busy on Tuesday, and we have got results out from a number of consumer-facing companies, including Electronic Arts, Airbnb and Starbucks. That's it from us. Enjoy the weekend, and we'll see you next Friday.